Hello and welcome to a new episode of Funded 360, and this is the fifth episode of Fundamental Analysis tutorial series. In the previous session, we looked at the profit and loss statement and went through the entire process of reading it in a step-by-step manner. Now that we are aware of the various terms used in P&L statement and their basic meaning. So now it's the time for us to move on having how to analyze the P&L statement. So in this episode, we will be diving into the depths of P&L statement and use the financial ratios to analyze and interpret the financial data of any company. But before we start to analyze any data or before we move on further with this tutorial, there is one key thing that you have to understand first, that is financial ratios. Financial ratios on their own way as such or a standalone thing that may not make much sense, but you will have to compare these ratios with those of the previous years or with that of the similar company in order to understand it fully about the growth of the company that you are going to evaluate. Or in case maximally what you can do is you can compare these financial ratio numbers with the companies of the same sector. For example, you can compare the financial ratios of HUL with ITC, not with the HUL with Bajaj Finserv. That you have to keep it in mind. So let's move further. For the sake of continuity, we will be taking up the profit and loss statement of the Hindustan Unilever itself, as we did in the last episodes for this ratio calculation also. For your reference, we are providing the snapshot of the HUL P&L here. Let's first try to understand the important financial numbers, ratios and their calculation. We know that there are so many financial ratios. So experts have classified them into four broad categories like profitability ratio, leverage ratios, valuation ratios and operating ratios. So usually an analyst, they use these numbers from both the P&L statement and also from the balance sheet. So for better reading as well as for the clarity, we will first take up only the ratios and numbers that you can calculate using the information from the P&L statement. First number that you can find it is operating revenue. The earnings that are derived from a company's primary operations are classified as operating revenue. So basically it tells you just how much a company earns through its business. It is calculated using the formula like operating revenue equal to total income minus other revenue. So in the case of HUL, the operating revenue that is indicated in the P&L statement itself, that has 38,785. The second figure that you have to focus is the operating expenditures or simply operating expenses. So operating expenses show the cost of a company that has incurred for its primary course of business. So that can be calculated as operating expenditures equal to total expenditure. From that total expenses, you have to deduct the finance cost and depreciation and then amortization. So let's apply this formula to HUL's case with the profit and loss statement, and just want to know how much operating expenditure it incurred during the current year and the previous year. So you can find that operating expense of the HUL for the year is 29,185 from the numbers by deducting 30,229, by deducting 106 crores and 938 crores. Those were the finance cost and depreciation figures. That's from the 30,229. That's the total expenses. On the other hand, on the previous year, operating expense of the HUL, that was 29,587. So the operating cost has been reduced. So the third figure that you have to concentrate is the earnings before interest, tax, depreciation and amortization, or simply EBITDA. So EBITDA is very important matrix that is used to determine a company's overall financial performance. So unlike the profit before tax PBT or profit after tax PAT, which only tells you the profits made by a company. So EBITDA gives you a fair idea of the company's ability to generate revenue. So we can simply say that higher the EBITDA, the better the company's financial performance. So EBITDA can be calculated as profit after tax plus taxes plus finance cost plus depreciation and amortization. Simple formula. So there is another formula also that can be used to compute EBITDA. That is, we have to deduct the total operating expense from the total operating revenue. So in the case of HUL's case, you can find that the EBITDA for the year 2019-20, that has been given as 9,600 crores. That means that we have deducted 29,185 crores from 38,785 crores. So as I told you earlier, in order to understand the sessions better, you please download the HUL's annual report from the company website or from the BSc or NSC website, so that along with this tutorial you can able to understand the sessions in a better way. So as we have mentioned in the beginning itself, so this standalone figure of EBITDA of HUL does not mean much. We need to know what was the EBITDA on the previous year. Then only we can say whether the company is growing or not. So in the previous year, the EBITDA that was 8,637 crores. So this year, or the year that we have taken into consideration, that is 9,600 crores. So obviously we can say that the company has grown by 963 crores. So the fourth figure that you have to take into consideration is EBITDA margin. So the EBITDA margin, this is a very useful financial ratio. So that help you to assess a company's efficiency. So this ratio shows how much of a company's profit that is derived from its primary operations. Generally, it is expressed as a percentage. So the higher the EBITDA margin, that means the higher portion of the company's profits come from its main operations. So in that case, you can consider that the company is very efficient. So the EBITDA margin that you can calculate as EBITDA divided by total sales. That's into percentage. Next figure is the PAT, profit after taxes, margin. PAT margin. So the PAT margin, that is also expressed in terms of percentage, and it's one of the simplest financial ratio to compute basically. So it is also among the most useful, though it's very simple, since that help you to determine the overall profitability of the company. So it is very clear that greater the PAT margin, better the profitability. So if you are concerned about the equation, PAT margin can be expressed as profit after tax divided by total sales. That's in percentage. That means multiply with 100. So in the case of HUL here, if you just substitute the values, you will get as PAT margin as 17.6%. On the previous year, it was 16.02. So obviously the PAT margin also has been improved. The next important ratio is interest coverage ratio. This is also known as debt service ratio. So this ratio allows you to figure out just how easily a company can pay its debts interest payments. Obviously, majority of the companies has debts. So nowadays in new age finance, we are not considering debts as a grave inefficiency or a great mistake, provided the company have to able to use those amounts that lended for the growth of the company. So how well the company can able to repay the debt, that basically this ratio denotes. So this ratio also shows you how much revenue is generated for every rupee of debt interest payment made by a company. The larger the interest coverage ratio, the more the capable a company when it comes to paying off its debt. Mathematically speaking, interest coverage ratio equal to EBIT, that means earnings before interest and tax divided by finance cost. How you can get EBIT? Usually EBITDA only given there in the sheets. So EBIT you can get it from EBITDA minus depreciation and amortization. So in the case of HUL again, if you take that for example, we know that EBITDA is 9,600 crores. So you have to deduct the depreciation and amortization from this figure. Then you will get as EBIT as 8,662 crores. On the previous year it was, so now we got EBIT. From there you can find the interest coverage ratio. So that is 81.72. What we did is 8,662 crores divided by 106 crores. Then you will get 81.72%. In the P&L statement itself the finance cost will be given. So what does it mean? An interest coverage ratio of 81.72. So this means that the company generates 81.72 times revenue for every single rupee of debt interest payment. That's pretty good, right? The seventh financial number that you have to get taken into consideration is cost of goods sold. So cost of goods sold is the cost incurred by a company for purchasing or manufacturing its finished goods. Cost of goods sold can be abbreviated as COGS. So COGS includes all the costs incurred towards the production and acquisition of the finished goods, including raw materials, labor, or some other expense or overheads. So the formula to calculate COGS that you can find here, that means cost of materials consumed plus purchase of stock in trade plus other expenses in connection with the purchase or production of finished goods. Other expense means like power or fuel or some lightning purpose or water or whatever it is. So in the case of Hindustan Unilever, the cost of goods sold for the year is 18,177 crores. How we got it? We add the numbers given against cost of material consumed and purchase of stock in trade. That's shown here. Along with that, you have to add the power, fuel, light and water cost, that also given in note 32 as other expense. The eighth ratio is operating ratio. The operating ratio generally that is used to determine a company's operational efficiency. So it establishes a relationship between the operating expenditures and sales. This ratio is typically used to find out just how efficient a company is when it comes to keeping its operating costs low. So the lower the operating ratio, the more efficient the company. So it is keeping the cost low. That's the inference of that. So mathematically it can be expressed as in ratio. That is, you have to first add the cost of goods sold and other operating expenditure. That have to be divided by the total sales. Total sales means net sales. That you can express as in terms of percentage. That's what operating ratio. In the case of HUL here, cost of goods sold are given as 18,177 crores that we have already calculated. Other operating expenses as 11,008 crores. How we have calculated it? It can be calculated as finding the employee benefit expenses. How we have calculated the other operating expenditure? That means we have added the employee benefit expenses, changes in inventory of finished goods, including stock in trade and work in progress. With that, we have added the other expenses, including with that we have added other expenses. But that other expenses we are not including, or we are excluding the power, fuel, light and water, since we already have that when we calculated costs. So redundant values multiple times we are not adding it, so that the figure will become wrong. So the net sales that has given us 38,273. Where you can find the net sales is that you can find it in the note 24, revenue from operations. There it's given as sale of products. That is 38,273. So operating ratio of HUL can be found as, you have to add 18,177. That means COGS plus other operating expenditure, that is 11,008. Then this has to be divided by the total sales, 38,273, and convert it into percentage. You'll get as 76.25. To give you some perspective about the implication of this ratio, generally for a manufacturing concern, an operating ratio of 70 to 80%, that is considered to be, for a manufacturing concern, an operating ratio of 70 to 80%, that is considered to be ideal. So here we got 76. So that's a very good number. So let's wrap up the session. So while these are the numbers and ratios that you can compute by using just the information in the P&L statement, there are several other ratios that you can calculate using the data that we can extract from the P&L statement that can be combined with the information in the balance sheet. You might have seen a lot of other ratios there in many screening softwares also. That also can be considered. And that's where we will be heading in the next sessions. So in order to understand a company in a very comprehensive way, in order to understand the fundamentals of a company in a very comprehensive way, just the understanding of P&L will not suffice. For that, we need a bigger picture. That bigger picture, you can get it from the balance sheet only. So in the next episode, we are trying to understand balance sheet and how well you can interpret or how well you can take data from the balance sheet to do a good fundamental analysis of any company. So that's all for now. See you in the next episode. Till then, bye from Anup.